The UK market notably outperformed the broader global index in 2025, particularly for sterling-based investors, and this trend has continued into the early part of this year. Part of the UK market's better showing in recent periods has been down to the makeup of the index, and notably the sector biases, particularly within the large cap segments, which have come into favour. However, the last 12 months has also shown the significant impact even just a small change in sentiment can have on relative returns, given how concentrated the global market has become over recent years. I have described in previous episodes how one metric we like to use as an input to guide positioning is what we term relative market implied returns. This measure derives a forecast rate of return, or IRR, and can be used for both individual securities but also market indices. It can be a really useful guide in my view, as it's long-term looking, which fits with our own investment philosophy, and it incorporates both growth and value metrics into the analysis, rather than simply one or the other. It also enables the ability to compare and contrast differing regional markets, irrespective of their structurally different growth rates and drivers. The UK market, and specifically the UK small cap and UK mid cap segments of the market, continue to screen well on this measure, and so I was very grateful to Guy Anderson from JP Morgan Asset Management for sparing time for 2 meetings with me in as many weeks. The first one, my regular fund manager research interrogation, and the second, earlier this week, to record this discussion for the Investor Insights series on the Mercantile Investment Trust. Welcome to the Investor Insights podcast, hosted by Killik & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik & Co YouTube channel, or by searching for Killik & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this week's episode, we were delighted to be joined by Guy Anderson, Managing Director within JP Morgan Asset Management's International Equity Group. Guy joined JP Morgan back in 2012 and heads up the UK mid and small cap investment team. He's responsible for the management of several UK growth mandates, including being the lead portfolio manager on the London-listed Mercantile Investment Trust, ticker MRC. At over 1.8 billion sterling market cap, Mercantile is the largest trust in the UK mid and small cap sectors. This scale leads to one of the lowest cost structures and generally highest liquidity in the sector. The JP Morgan strategy has an impressively consistent long-term track record, and in our discussion we cover the quality growth focused approach used by the team, and also how the company uses the levers available to it within an investment trust structure to its advantage. As always, please get in touch either via the podcast email address found in the episode description or via your Killik advisor should you want any further information on any of the topics discussed, and I hope you enjoy the conversation. Good morning, Guy. Thank you so much for sparing some time for this. How are you doing today?
Hi, Gordon. Yeah, very well, thank you, and really happy to be here.
No, great to have you on. So we've got this kind of standard question to these that, I mean, all it really aims to do is kind of get a bit of an insight into how you go about your work, really, or how you go about things. And we've been asking people if there's an anecdote they can share from a recent project or meeting that they've done, or even just an article or book that they've read. Is there anything you can share just to kick things off and give us a bit of an insight into how you go about things?
Yes, of course. I guess one of the key elements of our investment process is quite a lot of meetings with management teams, and so that is something that we spend a lot of time doing. And I often get asked about the value that those meetings bring, because to an extent, you could get a lot of the same information simply from watching the results podcast or one of the videos they have online. But one of the things we really try and do is stay up to date with companies to understand the current flow of how management are feeling, how they're thinking about adapting to the markets in which they find themselves. And that can occasionally be incredibly valuable. So I think a good example from just before the end of the year was, well, actually in November, we had a meeting with Trustpilot, which is the company that runs the Trustpilot review platform. And it was a pretty standard meeting. It was a case of understanding the business, their priorities, how they were managing profitability in different markets, because of course the UK is their most mature market, and them telling us that that's the most profitable market, and how there are other markets that actually, if they wanted to dial up the profitability, they could easily do. So that was interesting because the markets had a bit of a debate about the profitability. But then there was this little sort of aside, really, at the end of the meeting, which was just talking about fake reviews and how they were trying to manage fake reviews, and that it was a problem that they were grappling with, but they felt like they were making progress. And so that was sort of mentally parked in my head. But it really was just an aside in the meeting. Fast forward about 3 or 4 weeks, and there was a big short report that was put out by a fund, and it really hammered the shares, and the shares fell 30%. And the crux of the short report, the bear note, was that essentially Trustpilot was running a protection racket, in that they were effectively penalizing businesses that did not subscribe to them, and putting disproportionately negative reviews, and that they were doing nothing to really address those fake reviews. Now, the shares fell 30%, so that obviously says that the market was very worried about that. And sitting in our seat, we had a modest position in Trustpilot, but actually having had that meeting with them quite recently, and having had a few of those little comments about how they were managing those things, I took the view that actually this was not the case. And so I was willing to step in at that point, and we roughly doubled our holding on that down 30%. Now, of course, that may or may not have been the right decision, and ultimately, it feels currently like it was the right call, but ultimately we'll only know in the fullness of time. But the point of this is just keeping in the flow of companies, and actually understanding the nuances of how they're operating, how they're thinking, can at times, I think, be really valuable, and help us make decisions that in the absence of that knowledge might be harder to make.
Yeah, thank you for that. A good example of the value of company management. I had a question lined up later. I know that you do an awful lot of company meetings, or a lot of companies come through the JP Morgan offices. So wouldn't mind kind of getting a few more insights into some of those meetings. Perhaps we'll come on to that a bit later. The guy, I mean, obviously, Mercantile's got this focus on smaller or medium-sized UK businesses, and you often articulate the process as being one that seeks out companies with a few kind of characteristics that you look for, being kind of quality and improving outlook, and then obviously the valuations. I wondered whether, just for this audience, whether you could kind of run through exactly what that kind of investable universe kind of looks like in the UK, and perhaps some examples to kind of bring to life kind of what you're looking for that exemplify that process a little.
Yes, absolutely. So in terms of the UK market more broadly, because of course, at times, I think as a country, we're pretty good at doing ourselves down, if I'm honest. And I think there's a pretty big gap between perception and reality in the UK. And those people who've met me would have heard me say that before. But actually, the UK mid and small cap market is a really exciting market in which to invest. So if we look back over the last 30 plus years, the FTSE 250, which is the core of our market, has returned about 10% per annum, which is well in excess of large caps. And that's a phenomenon that we see in lots of different markets around the world. And that superior performance ultimately comes down to higher earnings growth. And when we look back over history, smaller companies have tended to grow at higher rates than larger companies. Not every single year, of course, but in aggregate. And of course, the compounding effect over time is pretty stupendous. And I think we're pretty lucky in the UK in that we have a really broad set of different investment opportunities that are listed in this market. And yes, of course, mid and small caps, they tend to be more domestically oriented, and at times that's a good thing, and at times that's not necessarily a good thing. But actually, even this domestically oriented part of the market, around 55% of the revenue is actually domestic and 45 international. So you have a good spread, but obviously from a sector basis, lots of different and pretty exciting industries and sectors, and more importantly, individual companies represented. So we think it's a great place to invest. In terms of a few examples, maybe to bring to life how we think about the investment process, I think probably one of the best examples that I can give is one that some people will have heard me mention before, but our investment in Games Workshop, which we made when this company was a small cap, probably nearly 10 years ago now. It was about 9 years ago. And this is a business that has grown from having been founded in the UK, now it's, I guess, 55 years ago, I think. But a business that has, for its entire life, focused very much on the customer and their intellectual property, and protecting their intellectual property and constantly developing it for the future. And that approach to business has enabled them to build this really loyal customer base of Warhammer fans who will year in, year out be their customers. But they are only at the start of monetizing that IP. Yes, they're quite well developed in the UK and in Europe, but they're only just scratching the surface in, for instance, North America and in parts of the Asia Pacific market. So we see this huge runway of growth. So it ticks all of our boxes. Very high quality business, really high margins, really strong returns on capital. But that improving outlook, I think, is fantastic. They've got this huge growth runway ahead of them, which will only be improved by the partnership with Amazon to generate live action content. In other words, television and film viewing. That will just, if that comes to pass, that will just amplify demand. And I think companies that are able to year in and year out grow their earnings like that will be rewarded by the stock market. And this is a company that absolutely has been. And of course, the shares have re-rated over time. But given the growth opportunity, I think it's still a fantastic place to be. A very different type of business, just to be a bit more rounded. We've got a large position in Serco, which is an outsourcing business that predominantly does government and related outsourcing services. So in the UK, people will be very familiar with them, but actually they have a large business in North America, Europe. They've got a small presence in the Middle East, big business in Australia, etc. So a whole range of activities that they do. And this is a business that has a pretty troubled history. So they had a lot of unprofitable contracts. They weren't generating any cash. They weren't generating any profits. It went through a long duration restructuring and turnaround, back then led by Rupert Soames. So this is sort of 2014, 2015. But it took a long time to improve that business because they are quite slow moving because of the long duration contracts. But what we've seen over the last sort of 5 years or so is profitability has improved. All of the profit has translated into cash, which is the best indicator that actually they're bidding correctly on their contracts. The business has tilted more into defense, more into US markets, which are typically higher margin for outsourcers. And the growth has, particularly over the last year or two, has picked up quite nicely as they're seeing more opportunities coming in at the sort of the top of their hopper, and their conversion rate has been pretty good. So that's an example, I think, of a business that was very low quality, but improving in quality. And because it's improved in quality, it's improved its growth, and therefore its valuation, where the starting point was possibly, 10 times earnings or something, has been able to re-rate into that improving quality. And that's a fantastically powerful combination where you get those lined up of profits growing and the market re-rating the shares. And hence that's been a fantastic performer, particularly over the last year or so.
Yeah, thank you for that. Some good examples there. I wonder whether we could kind of touch on the portfolio as a whole. I mean, you mentioned right at the start of answering that last question about the UK doing a pretty good job of doing itself a disservice. And we talked on this series about that kind of widening valuation gap of the UK market, just sentiment being generally weak. I mean, we've had a bit of a recovery in the UK market, but could you give us a kind of sense of what valuations look like in your space, maybe in the context of history, kind of where we sit?
Absolutely. And this is something where the fact that ultimately Mercantile is more quality growth than value, just to be very clear. And I don't believe that you should buy something solely because it's cheap. I think that's often a poor decision. But actually, when I think about the valuations that are on offer today, I do find it quite compelling. So just to sort of give you a few numbers, if I look at our portfolio today, the portfolio is on about an 8% trailing free cash flow yield, so historic free cash flow yield. It's also on about 12 times earnings. And 12 times earnings is about the same level actually as our benchmarks, sort of the FTSE 250 and the small cap combined. 12 times earnings is roughly 2 multiples cheaper than its long-term average. So long-term average is about 14. They're trading on 12. 12 is not the absolute nadir that it hits. If you look back to, say, the period of the trust premiership and the mini budget, etc., it touched around 10 times earnings for context. So I think that's an important data point to have in one's head. But what's also, I think, really interesting at the moment is the fact that when I compare the valuation of mid and small caps with large caps, in the UK specifically, it does look like a bit of a disconnect. So the FTSE 100 is roughly on it's on sort of 13 and a half times earnings, I think, from memory, which is roughly in line with its long-term average. But so with the FTSE 250 trading at quite a big discount versus its long-term average, the FTSE 250 is currently trading at a discount versus the FTSE 100. Now, that does happen periodically, but if I look at the past 20 years, the periods where that's happened have been 2008, 2016, and 2020 and 2022. So in other words, it happens at periods of what I would describe personally as sort of acute economic distress, particularly from a domestic perspective. So that tells me that the UK mid and small cap market is pricing in a really negative domestic economic outcome. And I don't think that tallies, and this, I think, in some ways is the most important thing, that doesn't tally with the reality that we're seeing on the ground. So actually, our portfolio has delivered net upgrades to expectations over the last 12 months. That's really important. So at the start of the year, we might be forecasting that the portfolio in aggregate will grow earnings by, call it 8% per annum. Now, that's fine. If you think about your PE ratio, that's fine if that 8% is achieved. If those earnings are not achieved and the portfolio suffers net downgrades through the year, that valuation wasn't a genuine data point. But if what we're seeing is that the portfolio is receiving net upgrades, it means actually the valuation is a genuine data point. And if anything, it is cheaper than it's perceived to be. And that's the experience that we're seeing at the moment. So whilst we're seeing the portfolio delivering upgrades, that gives me additional confidence and I think is a reason to be quite constructive on this part of the market.
Yeah, no, some really important points there. Thank you. Guy, I wonder if we could go back and talk about some of those, the kind of what you're hearing from some of the management teams, if I may. I mean, it's clear that companies at the moment, I mean, I guess they're always having to go through some sort of challenge, but it does feel like there's particularly a lot going on at the moment, whether it be kind of UK domestic policy or trade trade terms being changed by the US, or even, I mean, more recently this week, kind of technological disruption and the threat of AI and that sort of thing. I wonder whether there were any kind of key takeaways that you might be able to share from recent meetings that might give us a bit of an insight into how you feel businesses are coping and responding at the moment.
Definitely. So I think one thing that it certainly feels like companies have had to adapt a lot. If we just think about the last decade, the number of periods of quite serious change that companies have had to adapt and manage, and therefore improve, I guess, their resilience and the resilience of their earnings. And so that means that actually we're coming into a period where we could absolutely argue that change is accelerating for all of society, and that includes all the companies, and I would agree with that. But we're coming into it with generally what I would view as a cohort of companies that are actually getting pretty good at adapting to change. And that's really important because change is the one thing that we can bank on happening. And we can't necessarily predict exactly what's going to happen, but companies have to be adapt and able to adapt, and so do humans. And when I think about the questions that we've been asking companies over the last 12 months, of course, they've been dominated by tariffs and how they're going to be impacted and how they're going to navigate that sort of potential landmine or set of landmines. And at times, of course, those are quite frustrating conversations for the management teams because they're having to react in real time and getting interrogated by people like us about how they're reacting to it. But the other element, of course, is just bigger structural shifts in businesses. And the UK, as we all know, is a pretty high cost market from a labor perspective, from an energy perspective. And what that means is many of the companies that we're talking to are investing increasingly in automation. And what that will do is that will just insulate their businesses from more exogenous factors. So they can only control what they can control. But if there's a risk that wage inflation is going to continue to grow at above inflation levels, and I'm not saying that's going to happen, but that's obviously a risk, certainly for certain cohorts of companies, depending on their sort of employee mix. Those companies investing more in automation insulate themselves from that risk. So Cranswick is a great example. Yeah, it's a pork processing business. It's very manual processes, I'm sure everyone can imagine. They are putting in more machinery. They've got a lot of pretty sophisticated machinery. They're well ahead of the curve compared to their competitors in the UK. And that machinery is going to increase their capacity and increase their automation so that it insulates their business. And that's just one example of the sorts of changes we're seeing. But there are many of those that we could draw out. So increased investment in automation, increasing the resilience of the earnings profile of the businesses so that they can react to change.
Yeah, absolutely. And I mean, have there been any kind of common themes to recent change? I mean, given how much has been kind of gone on in kind of the macro, have there been any kind of recent themes to changes that you've made to the portfolio?
Yes, they have. I mean, it's probably a good point to reinforce the fact that the portfolio is very much built on bottom-up stock selection. So it is about the individual securities rather than necessarily having a sort of thematic view. But of course, one's top-down views in influence, which stocks we pick to include in the portfolio. And there have been some changes. But the other thing to mention about the changes is that this is in the context of a portfolio where we have annual turnover of around 25%. So last year felt like a year of, in some ways, elevated change. It certainly felt like that to me. It felt like it was quite a hard grind in reality. But actually, I think we turned over 28% of the portfolio. So the vast majority of the portfolio that was in at the end of last year was also in at the beginning of last year. Where I look at the changes that we've made, in aggregate, we actually increased our exposure to financials and we pulled back our exposure to consumer discretionary names. But when I look into the details, the financials that increased, it really was across a couple of holdings. It was a couple of new and reasonably large investments that we made into the portfolio. But the bigger shift was funding that by pulling back on some of that domestic consumer discretionary exposure that we had. Simply as we moved through the course of last year, we were able to observe that the consumer confidence was obviously not improving, and real wage growth was decelerating as the labor market loosened a bit through the year. So on the margins, less exposure to that end of the portfolio.
Yeah, no, thank you. I wonder if I could change tack slightly on this. So Mercantile's obviously investment trust got that closed-end structure. I wonder whether you could kind of talk us through how you use that kind of fixed capital pool and the structure of the investment trust to implement the strategy. I know there's kind of gearing at your disposal, and you've got the dividend policy there. Can you kind of maybe talk us through some of those?
Absolutely. And I think it's really important that investment trusts make use of the structure. Otherwise, it's sort of questionable as to what the point of having that structure is. I think the investment trust structure is really ideally suited to our part of the market. So, of course, investing in mid and small caps, we are investing in a less liquid part of the stock market, and having that long duration capital is really valuable because it means we can make those long duration investment decisions without having to worry about having to fund liabilities on a sort of daily or weekly basis, which of course we would have to consider if this was an open-ended vehicle. So I think that's the starting point. It's the right structure for this part of the market. The other element that I think we've been quite active on in terms of taking advantage of the structure is by the issuance of long-dated fixed cost debt. So back in 2000, the trust issued a 30-year debenture for £175 million, which obviously today has only got sort of 3 or 4 years left to go. But then in the summer of 2021, when you'll remember the rates were really quite low, we did our first set of private placements. So we raised another 150 roughly £1 million worth of debt in 3 private placement tranches spread at that point over 20, 30, and 40-year maturity with an aggregate fixed cost quite handily below 2%. So that's fantastic when we sit today, because we've got that long duration fixed cost capital that's at a pretty competitive rate that we can obviously invest in the stock market in order to gear the trust. And where we're sitting today, we are 14% geared. So absolutely making use of that. The other element that I think is important is the dividend policy, which is of course set by the board, so the independent board, and they have an objective. So the investment objective of the trust is obviously long-term capital growth, but the board have an ancillary objective, which is to grow the dividend at least in line with inflation over the long term. And when we look at the history of the dividend since adopting that policy back in 1994, I think it was, the dividend has grown at a 8.5% CAGR over north of 30 years. And over that time period, the dividend has never been cut. And today the yield is sort of, I think on a very backward looking basis, I think it's 3.3 or 3.4%, just to sort of frame it. So I think that's really possible because of the investment trust structure, the ability to pay out from reserves where necessary, and the board have done that on a couple of occasions, including through the pandemic, but continued to grow the dividend each year. And so I think we've grown the dividend every year for the last 12 years. So I think that's a pretty positive attribute, and I think it means it's an element of the return. Of course, nothing is guaranteed in life, but it's an element of return that investors can think about when they're thinking about the returns that we should generate. They can hopefully think about the income component with a high degree of confidence.
Yeah, no, absolutely subscribe to that as well. Yeah, two important features, the gearing and the dividend, important to realise with this. Guy, got a bit of time here at the end. We've got a standard opening question and a standard final question. The last one is just kind of asking the speaker to highlight if there's one particular area that they're particularly positive on at the moment, kind of one area of the portfolio that you have quite a high conviction on. Is there something you kind of highlight there? I know you've mentioned a few businesses as we've gone through, but is there anything you could share?
Yeah, definitely, and of course it's very stock specific, so I won't give you a theme or anything. But there are two holdings that I will mention, which operate in a pretty similar market, so we could think of them together. But we have two pretty large holdings in Plus 500 and IG Group, and of course both of those operate investment platforms for predominantly retail investors, but not solely retail investors these days, across a whole range of different financial markets. And I think it's a good one to mention because those are large holdings in aggregate. Those two holdings represent about 7.5% of the portfolio, so pretty chunky. Plus 500 is in my head because they've reported results this morning, which have been very, very well received. Pretty encouraging results. And of course, there's a lot of excitement about the potential to come from prediction markets, and that's something that of course we'll have to see as that evolves. And then IG, I sort of mentioned at the same time as that, because that was, I think, at a single stock level, the largest change in the portfolio through the course of the last year. So we started the year, we didn't have a position. By the end of the year, we had about a 3%, just over 3% position in IG Group. So a big change in the portfolio. And that's a company, of course, that has had an extended history of very strong economics. So they have really good profit margins here, up in the 40s, wonderful returns on capital, similar to Plus 500. So very high quality of cash and returns that we're getting out. But the interesting thing about IG Group is having for many years, I think, been sort of really quite risk averse and quite internally focused. The current CEO, Brion, who joined a couple of years ago now, he really joined with the mandate to really push growth and get them to accelerate the growth. And for the first year or so, it wasn't that clear, whether that was achievable, but we've absolutely over the last year or so seen that growth picking up and coming through. And I think when we consider the market in which we're investing, these are two businesses that naturally do well through periods of heightened volatility. And there's a whole load of risks that are abounding today that we're all aware of. And we may not be able to predict exact outcomes from those. But one thing that I think we can say with a high degree of confidence is that there will be periods of heightened volatility in the years ahead. And so nice to have a couple of holdings that can do well off the back of that.
Yeah, no, absolutely. Yeah. Guy, thank you so much for spending some time for this. Always really interesting to hear your thoughts. Yeah, thank you.
Great. Thanks very much.
Thank you for listening to the Investor Insights podcast, hosted by Killik & Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.